Okay, so good morning, everyone. Welcome to the macro snapshot. Let me just organize something here. We are Wednesday, March the 5th, 2024, about 7:30 in the morning. Okay, guys, I'll keep this relatively short. The big news overnight, I would say, was the not really overnight in the last 24 hours was what's happening out of Germany, and this is like a huge shift, a seismic change in the sense that Germany, as we know, has normally or historically been sort of fiscally conservative. They still have a historical memory of the hyperinflation of the 1920s in the Weimar Republic. So the point is that Germany has the debt brake, which is constitutionally mandated sort of limits on deficit spending. Long story short is that Germany has decided the incoming government and coalition with Christian Friedrich Merz as the chancellor, along with his allies, is to basically have a huge infrastructure spend of the talking about up to 400 or 500 billion euros. Also, about 500 billions on defense spending, and basically loosening the sort of fiscal spending constraints. So what this means is that Germany is essentially saying we've got to spend a lot of money over the next 10 years on infrastructure. We have to spend a lot of money on defense. And the market is taking this, apart from the geopolitics of Trump and Zelensky and Putin and Ukraine and Russia and everything. Simply from a market perspective, this is a huge injection of cash. It's essentially like a fiscal stimulus. It also represents symbolically the idea that Europe is sort of getting closer, and its most conservative major economy, Germany, is getting closer to being more relaxed, so to speak, about fiscal spending. So it's being taken as stimulus. So what are the results of that? The results, pretty simply, is that the market is saying that this could be a way of increasing GDP by 1.52%. I've seen different estimates over the next 3, 4, 5 years, and essentially a way of kickstarting the German economy and by inference the larger European economy. So this is a net positive, and we're getting this broader picture now of maybe a slowdown in the US because of sort of the tariffs, the uncertainty. And we're getting this sort of parallel shift that in Europe, maybe especially in Germany, things could start to get a bit of stimulus, whereas things are actually getting tighter and financial conditions are tightening in the US. So that has been reflected most clearly in the euro. And we see here the euro chart on the spot here. The very key level, which I've been looking at for a long, long time and signaling, the 105.30 here, which is basically there, basically blew straight past that. And so at this point, we really have to say, I mean, it's kind of interesting where we're going here, because if I put it on the exponential moving averages, you can see here we're above the 200, so we've blown past that. And if we look at the simple moving averages, you can see that we just touched it. So pretty important to keep some of these just up on your screens. And you see the 200 simple moving average here is at 107.25. That seems to be the top for the moment. But this is very strong price action. And you've got to say that there's a couple of other levels up here. There's different ways of looking at it. You've got a horizontal level a little bit above 107.75. And then this looks like a nice level up here, 109, something like that. So is this due for a pullback? Absolutely, it's due for a pullback. But we're seeing on all the crosses, you see Euro JPY ripping high, although that is an interesting one there. That's an interesting level there. Euro against, for example, the Aussie, absolutely going kind of almost parabolic at this point, you've got to say. So the Euro doing extremely well, but also big sort of effect in the bonds as well. And I just want to show you, for example, on a 3-minute chart. This is when the news came out yesterday about 1:30 p.m. or so. And this is, as I say, a 3-minute chart for the German 30-year. And you look at this here, just straight down, about German fiscal stimulus, about 500 billion euros. You see here, went down about 130 ticks on the future. So a huge move here. And basically, that's also being reflected in the curves, because most of this issuance, the idea is that this will be financed by longer durations, as we've been saying, 10 and 30 year. So that's going to cause the long-term yields to go up a lot more than the front end, which is going to cause a big steepening. And we can see, in the last 24 hours, let's have a look if we've got this here. Germany 2s, 30s. Yeah. So you see here, I mean, just a crazy steepening. And this is just on, this has been going for 2 or 3 days now on the weekend announcement about probably having more spending on defense and now the fiscal spending. And so the German yield curve here, the 2s, 30s and the 2s, 10s as well, are probably not as strong. Let's have a look at the 2s, 10s. But that gapped up as well. So the 2s, 30s. Now the question here is like, where could this go? This is an interesting one, or it's going to face some resistance. So already you're at points where we haven't been for a couple of years, going up to this sort of 1%, positive 1%. So you see here just historically, a bit longer term, that we're getting up towards maybe a little bit of resistance, but it could maybe go another 5 or 10 basis points. So basically the curve steepening there. And another way of looking at this, of course, and this could be interesting, is to look at the differentials. So if we look at the US 10-year, this is the interest rate differentials on the 10-year. To be honest, I mean, this is quite a dramatic move. I thought it might stop down here somewhere at around about 173, which is why I thought the Euro USD might reverse a little bit. But at this point, you've got to say that we're getting to a level which is, again, another sort of low point here of only about 150 basis points. So at this point, when you think about this in context, you had a situation whereby, just around about Christmas, there was about 2.3% difference between the US 10-year yield compared to the lower German 10-year yield, but that's now been reduced by about 80 basis points. And that, of course, is all being reflected in the euro. So if you overlay the Euro USD chart on this differential here, you'll see they're very, very highly correlated. So at this point, yes, you've got to say this looks like is this it? I mean, certainly if it blows through here on the lower, this looks as though it might go down another 20 or 30 basis points. So what would get it to do that? They would have to have confirmation. There's a European meeting this Thursday, like a conference or summit, where they'll be speaking about a joint European defense fund. The head of the European Commission, Ursula von der Leyen, was saying yesterday there could be another, was it 150 or 200 billion euros available for that. So if that's confirmed, there could be this idea that in Europe, definitely more money on defense. Now in Germany, I mean, it's gone a long way, this differential. Maybe it's due for a pause. Does that mean the euro's due for a pause? Yes. Now, what could weaken the euro here? I think what could weaken it could be like some severe tariff imposition by Donald Trump on European markets, maybe politically because it's through the coalition and it's quite messy because actually this a German sort of bill will be passed by the outgoing sort of Bundestag, which has anyway, I won't get into all the details. I'll spare you those. But the point is that there could be sort of political complications inside Germany, which actually this spending bill doesn't pass because the Greens don't agree with all of the spending increases. So it could be a pause. Now, the other issue is that and just before we get onto the US, just want to have a look at some of these differentials here with Europe. And you see here, what's kind of interesting is that you see just on these yields spiking in the in Germany, you see that the differential between the Italian and the German, which is normally much higher, that's actually it's come in even tighter. And we got yesterday almost just down to 1%. So we got to about 101 basis points or so. And the same thing with France. If you look at France, I mean, that's a sort of a false tick there, but basically France pretty contained as well. But my point is here, it's interesting because Germany at this point has said they are spending a lot of money. I'm just curious to know, especially in terms of the defense spending, at what point will France and Italy, will they start to sort of potentially spend? And at what point, if ever, will that sort of start to become a sort of a fiscal pressure? We might see some of those spreads going back, even up to 120 or something in the case of Italy, Germany. Pretty interesting. On the other hand, the other thing which, of course, we have to look at is the stocks. Obviously, we had a huge reversal in the pan-European. This is the stocks 50. So that doesn't fully reflect, let's say, a lot of the defense stocks. In Germany, because the Euro Stoxx 50 is actually just the top 50 kind of companies in Germany. So you have insurance companies, luxury goods makers, So it's not specifically, industrial as such, but that had a very nice bounce. And then, of course, you look at Germany, the DAX, very, very strong bounce up again. You're looking like up 3%, 3.35%. So very, very strong. So basically here, there's quite a lot of optimism in Europe that's being reflected in the euro. It's being reflected in some of the cross pairs. And even if we look at something like, let's say, euro Swiss franc, we had, if I can find it here, do I have a euro Swiss franc? Let's have a look. Sorry, there we go. So it's kind of interesting because last night we actually had higher than expected inflation in Switzerland. Not crazy, but a little higher than expected. And the euro CHF, it actually went down a little bit, but as you guys can see, swiftly reversed and testing a kind of a quadruple top here, which it looks very much as though it wants to sort of break through there. So a lot of positivity in Europe. Also, if we look over at China, we have the so-called two sessions meeting, big annual sort of Chinese Communist Party meeting. They were pretty positive. They kept their 5% growth target for annualized for the year. And they also released what they call their official growth report, which essentially said, the official policy of the state is to try and boost internal consumption, so not rely on exports so much. So boosting internal consumption. There were like hundreds and hundreds of points, like trying to boost the property market, trying to boost this, trying to spend money on this. So fairly stimulatory without being sort of a crazy infrastructure kind of bazooka, which we saw many years ago, 10 years ago, but basically relatively positive. And so if we look at the Chinese stock markets, if we try and see the reaction of those, we can see that, let's say in the China 50, muted reaction, the Shanghai 300, a positive, not crazy. If we look at the Chinese mainland stocks trading in Hong Kong, that got a little bit more attention. So, a little bit of positivity coming out of China as well. Be interesting today in the US markets to see the FXI, which is the large cap ETF. So you can see in the pre-market, that's up, a bit. It looks like a couple of percent or so. So, a bit of positivity. So what we're starting to see is, some signs of stabilization or even positivity in China. Europe is going through sort of a happy moment. Although I still think a peace deal is going to be messy and complicated. So that brings us back to sort of the US. And if we actually look here at the US, let's first of all look at volatility, which actually as recently as yesterday was a very high level, 26. So a lot of volatility in the stock market. If you look yesterday, we had a pretty crazy, just to put on a 3-minute chart. I mean, I guess everyone was looking at that, but just looking at this sort of the close yesterday, and like this is tricky to trade. So you had this crazy at 3:30, you had a huge drop of 400 ticks, about 100 points. And that had been preceded earlier, just a couple of hours earlier, by a 500 tick sort of bounce. So a pretty tricky, in terms of intraday trading this, and even, people doing sort of trend following. This is a lot of volatility on these short-term timeframes. And that makes sense. If you have a VIX at 26, as I say, divided by 16, you'll get the implied sort of average daily move. And you're getting, something like 1.6, so 1.65% average daily move with a VIX up at 25 or 26. And so these kind of moves are to be expected, this volatility. And a lot of this is a policy based, absolutely incredible volatility coming out of the Trump administration. So just looking at the S&P, let's look at the SPX, so the cash index here. You saw yesterday that it actually blew through the election gap, which had been a resistance, stopping at the 200 simple moving average. It's interesting, at what point, if ever, does Trump come in and, the so-called is the Trump put, that he says, okay, that's enough, too much chaos. But he did say in his speech last night, which I painfully endured, that he said he loves tariffs. He says, again, tariffs, it's a beautiful word. He firmly seems to believe that tariffs is a net positive. He did acknowledge that there could be a little bit of, what did he say, short-term pain. So I guess what he's saying here is that there could be a little bit of unemployment. There could be some, again, in Trump's words, some readjustments, some temporary readjustments. And I guess the administration, are relatively happy with the stock market going down a bit. And we had Secretary Treasury Bessent saying that they're really focused on Main Street and not Wall Street. And he specifically said, I think it was yesterday or the day before, that Wall Street has had a tremendous 2 or 3 years, and it's now time to rebalance global trade. and to focus on trying to improve the lot of the middle class. And so the coded message there is, I guess, is what they're saying is that if the stock market has, a further 2, 3, 4, 5% to fall, they seem to be okay with it. We shall see just how much pain they're prepared to take. But just in the meantime, let's keep an eye out on this 200-day simple moving average. That seems to be sort of a lower resistance point at the moment on the cash, on the SPX, on the ES, on the futures, more or less the same thing, a little bit different, but again, finding support there. But this morning, had a little bit of a bounce, but trading in the red. And again, compared this to Europe. So there's definitely this whole divergence play. And really, I think what we're going to have to try and figure out is, is this justified? Because sure, the Europeans, specifically the Germans, seem to have done a bit of a historical change here by opening the floodgates, opening the taps of fiscal stimulus. But this is something I was reading this morning, an analysis just saying, listen, no projects have been identified so by the time they sort of green light the funds until the time they actually start, digging up roads and building new train tracks and, digital infrastructure, this could be at a minimum many, many months, probably talking years, timeframes of years. And so I'd be curious to know how much this sort of sugar rush, how long the sugar rush lasts. On the other hand, if we look at the US economy, you have to say, are there signs that the US economy is slowing down? Like, is it actually really slowing down? The employment situation is still pretty strong. You've got little indicators here and there, like the Atlanta GDP, the Atlanta Now GDP showing some, a little bit more weakness. ISM, some of the ISMs are slowing down a little bit, but the survey data, we really need hard data to tell us that the US economy is slowing down. So I'm still not 100% convinced about this divergent story. Suddenly everything's flipped that, Europe's wonderful and the US is going into the garbage bin. However, it does seem that if we just step back, that tariffs are still favored by Trump, and it's going to be very messy and there's going to be huge amounts of compromises, but he still, in general, seems to favor tariffs. Last night in his speech, he again mentioned April the 2nd as a reciprocal day for tariffs, or the day that reciprocal tariffs will be imposed on everyone. So tariffs seems to be here a little bit. And at the end of the day, that they do seem to be potentially slightly inflationary, a little bit sort of a drag on growth. So it is possible that that will happen in the US. But if that happens, if the US, as they say, catches a cold, the rest of the world catches a cold as well. We shall see. Today, we do get some a little bit of data, and starting this week, further out this week. So if you just look at what's happening, in a while, we have the ADP report, which is happening at 8:15, expected to be 140,000 jobs. ADP has not been a great leading indicator of the non-farm payrolls, but nonetheless, it is a huge private payroll company, so that will give us some sense. We get final numbers for S&P US Services and Composite PMI. That's already pretty much known. What's going to be interesting is start looking at things like the factory orders, durable goods. It's a second reading again, so maybe not a huge amount of information. Probably what's going to get the market's main attention is at 10 o'clock is the ISM services. This is very, very important because we know that services consumption is about 70% of the US economy, even though manufacturing it reacts more quickly to sort of downturns. Especially important, I think, it's got to be new orders and employment, just to see if there's any sign of weakening in the US economy. Although, again, this is a survey and it's not hard data. And secondly, let's keep an eye, of course, on the prices paid. And, if we're getting this sort of stagflationary kind of sort of movement. The other thing to sort of look at, technically, yesterday we had a pretty robust verbal response from Prime Minister, the outgoing Prime Minister of Canada, Trudeau, who called the tariff down on Canada. And it's just interesting to look at the reaction here, because if you look at the Canadian dollar, this is USD CAD, just on the imposition of the tariffs on midnight yesterday. So that's Tuesday, 12 o'clock, let's say midnight. And basically, you can see here that the US dollar, it initially spiked up, but then it's weakened as if to say, hey, actually tariffs is going to be more of a drag on the US economy than the rest of the world. And then there's been all of these kind of, there was some headlines last night from the trade advisor, what's his name, Lupnik, of the US, who said that potentially today, Wednesday, March the 5th, Trump might alleviate some of those tariffs on Mexico and Canada, or maybe if he thought that there'd been enough progress on drug importations and the Mexican cartels, he may take them off completely. He may remove them completely, which would be a positive for CAD. So we could expect this to go down further. So a lot of volatility. A complete lack of, how can I say, consistency in the tariff policies coming out of the White House. And so just challenging to hold these positions and see what's going on. But the market does seem to be basically saying, if you look at something like the dollar index, which is down a lot and hitting its 200-day simple moving average, that overall, the market is saying that all of these shenanigans from the White House and the tariffs will be, a deflationary and a low growth, an anti-growth kind of story, which is going to hit the US particularly, and that's being reflected in the US dollar. And of course, that's also being reflected in the yields, which have been going down, and the repricing of the Fed. The Fed is now priced for almost 3 cuts by December of this year, compared to only one about 2 or 3 months ago. So, the interesting story here. Again, I personally think this is starting to get a little bit overdone. I understand the excitement in Europe, but at these levels, I'm going to have a look at it today. I'm just thinking, is the US dollar going to sell off more, break this 200-day SMA here? Interesting, we'll see. And again, we'll start to see some of the data coming out today, and then tomorrow, and then on Friday. And if it does show that the US economy is still robust and the US employment situation is robust, maybe we'll get a turnaround in the US dollar and just a bit of a cooling off in some of this enthusiasm over in the European space. But that's the situation we have today. Just finally, guys, I don't want to keep it too long here. Just looking at oil, kind of interesting that oil, despite the overnight news that China's looking to sort of boost the demand a little bit, oil, I think it's just technical here. It is wanting to retest these lows. This is the April. This is the front contract here. So oil down quite a bit, and that's interesting because we have had a softer US dollar. Also last night we had the API, so the private payroll, which came in with a draw. So that was like a well, that's positive for the US sort of crude prices in theory, but WTI here not having anything to do with that. And if you look at the CL1 contract, you see here that is starting to retest. It bounced off these levels yesterday, but starting to retest some of these lows. I do believe if this goes too much lower, another dollar or two, there's a big trend line here, this gray line here going back quite a long time. That would represent, potentially sort of an interesting sort of buying opportunity here. You see this trend line going all the way back to August of 21. So that's quite important. So it wouldn't surprise me if oil pushes down a little bit into the mid 60s, 66, 65 on the CL1 contract. And if you look at the front contract here, which is one I'm also looking at, April, I think it probably makes sense that it wants to test down here to about, let's call it 65, 50, 66, something like that. I think some call spreads there could be interesting, just based on the fact that a lot of this sort of negativity about US growth and the tariffs, I think a lot of it's been priced in. I understand that the OPEC Plus is going to be sort of increasing their output, but at the end of the day, those numbers are not enormous, and that news is starting to get priced in already over the last 2 or 3 days. So I think oil, another dollar or two lower here, maybe just wants to flush out, trigger some of these stops down here at around about 65.90 on the April contract. If it can succeed in doing that, I think some call spreads over maybe 6 weeks or 8 weeks could be kind of interesting. That's something I'm looking at. Okay, guys, I'll leave it there. Have a great day. As I said, we have ADP at 8:15. Then probably more importantly, we have the ISM services coming up at 10 o'clock. And no doubt there will be some headlines and comments from you know who throughout the days. Thank you. Have a great day.